US stocks are having their worst start to a year in nearly a century. At the same time, inflation is rising at the fastest pace in around 40 years. In times like these, folks are looking for places to put their money where they won't lose it, but can also see some gains. With that in mind, I want to tell you about one long-spurned asset that has recently become a favorite among top Wall Street money managers: cash. I'm going to tell you why some on Wall Street are holding cash right now instead of buying the dip, how we're seeing this trend play out, and I'll tell you about some investments that Wall Street pros are using to earn a little return on their cash. Let's get into it. I'm hearing it more and more from the professional money managers I talk to. The increased volatility and uncertainty that we're seeing in markets is expected to continue. That's due to the ongoing war in Ukraine, disrupted supply chains, and central banks raising rates to fight inflation. We've been living in a low inflation world for more than a decade, and it looks like we're entering a new regime. When things change, it can take a while before it becomes clear what the winners and losers will be. That's why some of the world's largest asset managers say they're happy to have their money in cold, hard cash these days, as opposed to buying the dip. Directors at multi-trillion-dollar asset managers like BlackRock and State Street say they have increased the cash holdings in many of their portfolios by at least 50%. Gaurav Malik, chief investment strategist at State Street Global Advisors, tells me, cash is king right now in terms of the return you're getting. Bank of America's latest survey of global asset managers found that putting money in cash was the most popular investment strategy. But major money managers aren't burying their dollars in the backyard and getting 0%. They're holding cash-like assets, and those are paying higher rates than they have in years. Now that the Federal Reserve has raised US overnight interest rates to at least 0.75%, some money market funds are paying 0.8% annual interest. Asset managers say they also like short-duration Treasury bills, which mature between 1 and 3 months. Those are backed by the US government and are currently paying between 0.5 and 1% annual interest. Everyday investors can buy those straight from the government through treasurydirect.gov or through brokerages. And speaking of Treasury Direct, every US citizen can buy Series I savings bonds, which are paying 9.6% annual interest right now. For all the details on I-bonds, check out my video from early April. The link is in the description. Certainly, earning 1% interest, or less, isn't all that exciting. But if the Federal Reserve keeps raising interest rates the way they've predicted, cash-like investments could return 2 or even 3% by the end of the year. And with the S&P 500 off to its worst start since 1932, 2 or 3% isn't half bad. The late Slauson Avenue legend Nipsey Hussle blessed us with some wisdom. He said, "Now it's up to you. Are you gonna take heed and get paid and scream all money in until your dying day? Say, forget the middleman, get on your grind and save? Or are you more the type to have your mind enslaved?" That's all for now. I'll see you next time.